Hi everyone, Tim Barry here again on another issue that just came up recently with a self-directed 401k. And what happened in this case is we had somebody set up their self-directed 401k, and first issue they had is they didn't have a business. They didn't have a valid business. Now, this is just an incredibly basic concept about self-directed 401ks. The first sentence of section 401 of the tax code, and that's where they get the 401 from 401ks from, but the first sentence of section 401 says it's a plan, a trust, established by an employer for the benefit of their employees. If there is no employer, we can't have a valid 401k plan. So first big issue, people, if you don't have a valid business, you can't have a valid 401k plan. And by the way, getting rental income from rental properties is not considered a business for the purposes of the 401k rules. So first big issue we had was somebody didn't have a valid business. If they don't have a valid business, they don't have a valid 401k plan. Now, whenever they roll their money from their old retirement account into the 401k, if it's not valid, that's not a valid rollover, and they have a taxable event. Disaster. So that was disaster one in this scenario that we just saw. Disaster number two. After a couple years, they actually did get a valid business up and running. Woohoo! We had a valid 401k. Life is good. Life is fantastic. Okay, so we have a valid 401k. They're rocking and rolling. And then what they decide to do is they decide to move their spouse's money. Their spouse was retiring, and they decide to move their spouse's retirement money into this 401k. Okay, cool. That's allowable. You're allowed to commingle husband and wife's assets inside the 401k so long as both parties are providing valid services. And let's put it a different way. In order to be a participant inside the 401k plan, both parties have to provide valid services. Well, guess what happened? In this case, the spouse who was retiring, they moved their money inside the 401k plan, but they weren't on payroll. They weren't a joint owner. They didn't provide valid services. So we go back to that first sentence of section 401 again. First sentence of section 401 says, this is a retirement plan established by the employer for the benefit of their employees. If the spouse who moved money into the retirement plan isn't an employee, doesn't receive compensation from this entity, they're not allowed to be a part of the retirement plan. So once again, we had a disaster of whenever the spouse moved their money inside this retirement plan, it wasn't a valid rollover. That's a taxable event. So let me keep it incredibly simple. In order to move money inside of a self-directed 401k plan, or any 401k plan for that matter, in order to move money inside of one of those retirement plans, A, you have to have a valid business and rental income isn't good enough, and B, you have to provide valid services to that business, or anybody who's going to have their money inside this retirement plan have to provide valid services to the business. If you have any questions, shoot us an email, give us a call. More than happy to talk to you about it. Oh, and by the way, do me a big favor. My YouTube guru says I have to ask everybody to subscribe to my channel. So please subscribe to my channel if this is the sort of information you like, and leave some comments down below too as well. Thank you very much for your time.